You are live.
Hey, everybody.
Hello.
Bill Fairman, Wendy Sweet. Jonathan Davis is just getting ready to
he's
pop in
here.
and
He's
join
here.
us, but he's
Yeah, it's hard to hear.
so he's going to sign language for us while he's over there, since his audio isn't working very well.
It was working, and we tried to make it better and made it worse.
Hey, do this. Write something down and then hold it up to your camera. So, Bill Fairman, Wendy Sweet, Jonathan Davis, Carolina Capital Management. Our website is carolinahardmoney.com. If you're a borrower interested in borrowing money, then click on the borrower tab. If you're an investor looking for passive returns, click on the investor tab. By the way, don't forget to like, share, subscribe, like the screen says. And then we have a little chat there on the side. You can leave a comment or ask a question. What Wendy and Jonathan and I are focusing in on this show is the tough questions.
Well, actually,
let's
talk about how we got to this point. So we love sharing the incredible network of people that we know. We are so blessed to be in groups, other masterminds across the country, and the people in there are just, mind-blowing intelligent, and we love being able to, pick their brains and share the knowledge with everybody else that we get to hear. So we love being able to share that with others. So we've got great people that we can interview, but Scott Patton, who is the man behind the video here, helping us do all of this.
You can't see him, but he's waving it up.
That's right. Hey, stop using that finger. Anyway, he turned us onto a book called They Ask, You Answer. And it's an excellent book by Marcus Sheridan. I highly recommend you get that book and listen to it if you're a business owner.
It's available on Audible too.
Yeah. And I'm starting my second round listening to it again because it was just so good. But what it really talks about is not only the art of using video on your websites, when you explain, who you are and what you do to people, but also
what you do for people.
I coupled two sentences together there. But anyway, so obviously I need to practice on my video speaking. But what was really important is answering the questions that hurt. And that's, we've always felt like we were pretty transparent in what we do. We're an open book. We spill it. We want to communicate as much as we can. And we're always trying to improve on that, and no matter how much you think you communicate, you can always do better. And that's how we feel about it. We want to continue to just spill it, let people know what's going on behind the scenes and how this business works. The more educated we all are, the better. And the more that our clients know, the easier it is for us to work with them, right?
Yeah. It all boils down to educating the consumer so they can make an informed decision.
Right. Whether you're a borrower or a fund investor or a lender or whatever it is you do.
Yeah. No one likes to be told who to buy from, what to buy, that type of thing. You want to make that decision on your own.
That's right.
And the problem is most companies do not post unbiased.
That's right. They're pounding their chest on how great we are. They're always selling, right? Always trying to show the really pretty face.
The big thing that gets to me, if I'm looking at a house to purchase,
and
they don't put the price.
Yeah.
I will not even go any further with that. They think that if the price is not there, then they'll get somebody to call them.
Yeah. Yeah. That makes me think, it's too much. I don't want it.
And even if I do, as a business owner, why do you want to waste your time with somebody that is not in their price range anyway?
That's right.
It's just a wasted call.
That's right. But what this book is doing too, there's how many funds are out there in the world? How many options for a different fund is out there in the world?
Well, there's tons in the stock market.
A gazillion of them.
And then there's actually quite a few in the private market.
That's right. And they all have their own little personality. So if I'm a fund investor and and I want to put my money into a fund, but how do you choose which one? So who are you going to ask to compare that? If I get into your fund, what makes your fund better than this fund? That's it's difficult to get an honest answer from anybody. Everybody's going to promote their own thing. So what I really love about this book is that, excuse me, they're talking about how important it is to just go ahead and talk about everything right up front. And he uses an example of pools. He was a pool guy, and they did fiberglass pools. And one of the main questions they got was, what's better, a fiberglass or a concrete pool? What's better? Well, it doesn't really mean one's better than the other. It's what is it that you're looking for? What's most important to you? Let me tell you all the things.
The best fit?
And that's right. What's the best fit? So here's all the things about fiberglass. Here's all the things about concrete. You make that decision as to what works for you. And that's what we want to do about funds. There's, we're
not just funds, but
borrowing money. We want to be able to give you the information and let you make the best decision. And I think
so. That said, going forward,
right,
we're going to provide
ugly questions
each week. We're going to go over questions that people want to know.
That's right. We actually went in our office, and we had everybody in the office come up with 10 to 20 questions that they get asked on a regular basis. No matter how stupid they seem, or no matter how crazy it seems, no matter how much it hurts to answer the question, we don't want to hide anything. We want everybody.
We want you to feel the pain.
Yeah. Well, we don't want you to feel the pain. We definitely don't want that. But we want you to know what we know. We want you to be able to make an absolute informed decision. And we think the only way to make that happen is to give you, the viewer, an opportunity to ask ugly questions. So anybody who's on our email list got a what's it called? A survey monkey saying, hey, we're looking for ugly questions. One of the questions this guy was asked in the book, and I thought it was that one was a stab right in the stomach, but it was a great question. The customer said to him, as he's sitting at the table trying to sell him a pool, he said, okay, so if I decide not to use your company, who would you recommend I use? I went, oh, that's tough.
Yep.
Another question he got was, who are the 5 top best pool builders in Richmond, Virginia?
Actually, that wasn't a question. He answered that in an article based on that first question.
That's what he did. He did a top 5 on there, and he didn't include his own company,
right? Which
I thought was interesting because he didn't want to toot his own horn.
Yeah, and it makes it look like you're giving a biased answer if
you're
adding yourself in there.
Yeah.
But what it did for him was every time somebody Googled best pool contractors, the article on his website came up.
Which always helps. But the bottom line is he was open and honest, and he promoted five other pool companies, which I thought was really, really cool. And we do that. We've got so many fund manager friends that have great funds that are well worth investing in, they're honest as the day is long. They're solid people, and their investments are good. And we love promoting them. We've had many of them on our show.
And at the same time, we're always promoting diversity.
Right.
Anyway, and everybody's in a different place in their investing life cycle.
That's right.
And so we may not be a good fit for you, and somebody else may. Jonathan, say hi.
Hey, everybody.
Hey, we can hear you. Did you run to the store and get some earbuds?
No, I had to actually just switch it over to my phone and run it through that. Yeah, I don't know what's going on.
You sound great.
Thank you. You can actually hear me now, right?
We can hear you and see you.
Yeah, good.
Sound like you're talking from a 50-gallon drum.
Yeah, that's awesome.
I do now?
No. You don't.
So let's get to our question.
Okay.
So the question for today is, what happens to my investment
Mm-hmm.
if the economy goes south?
Right.
All right, who wants to tackle that first?
I mean,
Go, Jonathan. You hadn't talked enough.
yeah.
Did you hear
know,
the question?
yeah. So, what happens to your investment when the economy goes bad in the South?
Right.
Whatever. I think Wendy and I were talking about this earlier, and it's one of the things that I think we like to hit on is there's no such thing as a bad economy. There's just an expensive one and then a less expensive one.
Yeah.
Like that's that's generally what it is. It's always expensive. It's just whether it's more or less. So what happens to your investment? Like, what are you invested in? Will determine that. And what I think we try to tell people is know what you're investing in and know your remedies and know your exits. So if you're going into something and you go ahead,
say not just your remedies and exits, but the fund's remedies and exits as well. Go ahead.
Whatever you're investing into, their remedies, their exits. If it's a single asset, if you're lending, if it's equity, if you're doing JVs, whatever the investment is, like you need to know all of your exits, all of your borrowers, partners, whoever you're working with, their exits, and you need to know all the remedies. Because the biggest issue that I see, and maybe you all have seen different things, but what happens when the economy changes, people don't know their remedies. They don't know their exits. And that's what causes panic, and that's what causes bad decisions, and that's what causes loss of money. Like that's generally the flow of what happens. I don't know what I was supposed to do when this happened. Now I still don't know what to do. So now I'm just going to make uninformed decisions or scarcity mentality decisions or whatever decisions they are. They're not coming from typically an informed or abundant place, and that's where money gets lost. And I think that spreads across the whole board of whatever investment you're doing. So whether you're investing into a fund, what's that fund investing into? What are their exits for that? Like us, I know we've talked about this a few times. If we do affordable housing, fix and flips, bridges, other, bridge loans, stuff like that. If something happens, we can pivot into property management, into collecting income via property management. Like that's a way that we can do that. So that's, when you're investing in these things, you need to ask those tough questions. Like one of the things when we're signing contracts and putting together JV agreements, that paperwork, that document is for when everything goes wrong. While everything is going good, you never look at that paper. You never read that document. So you need to ask those tough questions that would be answered in those documents ahead of time to know your remedies and know your exits.
So I love what you're saying, Jonathan, and I think it's important, very important when you said it depends on what it is you're investing in. Is it a single purpose fund? Is it a new apartment being developed? Is it a hotel fund? Boy, that'd be scary to be in a hotel fund right now, wouldn't it?
Yeah, it would be. I mean, office condo fund, any of those stuff. Like, it's tough, but now they may not be like giving disbursements out, but you need. What are their exits? What are their remedies? What are they doing right now? I mean, it's I think we all joked earlier. Oh, we're just putting our head in the sand and hoping things around us get better. Is that what they're doing? I mean, if they can't answer those questions, then I think that's a good indication for you that maybe that's not a place that you want to keep your money.
Or it might not be a place you want to get your money back and run either. I mean, we've got a really good friend that has a fund that invests in commercial property. And, I have been watching how he's been handling this whole COVID scenario because, commercial properties really hurt. And, what I thought was really interesting, and this is what should make his investors and the fund feel very safe is, he immediately hoarded his cash, made sure that, they weren't going to lose any money, buy anything else. They were very controlled on the cash. They didn't pay dividends out, but they didn't pay it out because they didn't earn them. They're not taking that away from them. They'll get those dividends at some point, but they didn't get them on the release time that they thought they would because they were smart. They're holding on to that cash to make sure that they have the money that they're going to need in case things were to get any worse. So which is smart, because a lot of people would have just gone ahead and paid out those dividends because they would want everything to look good for right then in that quarter and make everybody happy. But what they're doing is they're thinking long term. They're he's truly protecting their money.
Well, that's you hit the nail on the head for those guys who are doing that. I mean, yes, it can give you your return, and money today always sounds good, but they're not protecting. If they do that, then there's a potential that they're not protecting the asset or assets that's backing your money, not just your quarterly distribution, but your actual principal that's in there, and they're not protecting that if they're giving distributions out without thinking, okay, well, what could happen down the road? So you're 100% right.
Go ahead. I'm sorry.
I was going to say one of the dilemmas in commercial property right now is really the unknown. If it's office and retail, hospitality, those properties are not going to be worth as much,
right?
Because those are the ones that are hardest hit. And if you're in a fund that owns a bunch of these assets, more than likely the values of those properties are going to be written down a bit.
Right.
Because you have to have a fair market value of the asset. So if at some point the fund has to disperse all the assets, it's got to be the fair market value. That said, if you're diversified and you have money in a lot of different buckets, this bucket is going to provide you with a loss to go against your taxes.
Yeah.
There you go. Yeah.
So you have to look at it that way too. And then if you're holding on to that for a while, it's still more than likely going to produce some sort of an income. And at the same time, that value will eventually start coming back up. But assuming none of us have a crystal ball, but you're invested in the fund for a long term, and everybody is in a different cycle in their investing life.
Yeah, some people have kids in college. Some people,
if
are just going into retirement.
Yeah. So if it's a longer term investment, it's not that big a deal. You're going to get a write off now, which is nice because you're going to pay less taxes, which will also you're going to add depreciation to it too. So you're going to have a big write off.
Right.
Of course, don't try and get a refinance on your home mortgage because you're not going to show any income.
Well, and that's the other thing too. Some people that are fund investors are living off the dividends that they get.
Right.
And some people are leaving it in there to compound. So it really depends on, on what you're doing.
If you're living off the distributions or the dividends, you don't need to be in a higher risk fund anyway. So, and let me just point this out. If you have really high returns, you're at a higher risk.
Right.
Typically,
it goes hand in hand, right?
The reason the reason you accept the lower returns is because of safety. Or sometimes it's because of safety and because of convenience. But typically the way it works is the higher the return, the higher the risk that's involved. So as you're moving towards your collecting dividends now for income, you need to be in less volatile spaces. Right.
And, we were talking about the commercial industry a little bit in the beginning. And we actually, Jonathan and Bill and I are in a building that we've purchased together. And we purchased it right before COVID hit.
Great timing. Love the timing.
So the timing was great. We got a great deal on it. Seller financing, and had hoped that we could rent some of the office space out while we were using the portion that we needed, because it's a little bit bigger than what we needed. But it's just in a great area. It had all the great things that would go along with it to be a good deal. But we're sitting in a position where,
By the way,
it's what
they just started demolition on that building that they're putting a brand new hotel that no one's going to stay in.
Yeah.
Right next to us.
No, we're betting that the economy is going to come back for sure. But I mean, so everybody is going to be faced with making decisions on investments like that. Just like us, we know what we're doing in it, and black swans can affect everything that you do. But the good thing is that building is not going to make or break us. Which is another thing that you need to think about when you're
And
making.
we wouldn't have done it if it could have.
That's right. That's
Exactly.
right.
Yeah.
And that's what people need to be thinking about. If the worst case scenario happens, how would this affect you? What would it do to your lifestyle? How would it affect your lifestyle? Are you going to have to go back to work? Is it going to, change the fact that you can't afford that big mortgage payment anymore? If that's the case, then maybe you shouldn't be investing in something that always has a possibility of losing, right?
Yeah. Well, back to the original.
Boy, we're making it sound
question.
fun to invest.
So what happens to your investment in our particular fund? We were fortunate that not fortunate. We're fortunate that we're smart enough to be in these mastermind
Right.
groups. And
That's
we
exactly
had
right.
last year made the decision to go into even less volatile loans, because we stayed in the single family and multifamily, but they're all affordable housing.
Right. And we knew, I'm not going to interrupt. I'm going to
You are interrupting.
insert just a quickie.
Stop touching me. It's COVID time.
We knew that it would make we knew it would reduce our return rates. We knew that would happen. But we knew that was the smarter way to go, because we're looking farther out in the future, not what's going to happen next quarter or the quarter after that.
Right. And a couple of things to this. The more affordable housing is easier to sell quickly, whereas your luxury real estate, it takes a little longer on the market. Secondly, if for whatever reason we couldn't sell that property, if we had to take it back, at least we could rent it out for
Right.
expected returns. That said, when you go through a down cycle, and we're doing the same thing. We're trying to hoard some cash and make sure that we have plenty in case any issues happen.
Right. Absolutely.
It can always go back and back to the investors eventually, but you're doing it because you're playing defensive.
Right.
So what you're looking at is you're probably going to get returns at the bottom part of your trading range. Our expectations were 7 to 9%. You're probably going to see on ours closer to 7 than to 9. When things pick up, they'll be closer to the 9 than to the 7. The same thing with any other funds that are in there. They all have trading ranges or expectation ranges where they're going to be higher or lower. And I wouldn't fear too much of this as long as you have a good operator in place and they communicate with you properly. You're still going to, in my opinion, outperform the stock market, because your money is still backed by solid real estate assets, where in the market your money is backed by someone else's business model.
That's right.
Period. They don't really have any assets.
That's right.
Other than Walmart, they buy their own buildings. But,
Yeah.
for the most part, you're just invested in somebody's business model. And we saw how many business models went belly up recently, right?
Yeah.
That's exactly right. The other thing too, I think and you mentioned this in the very beginning about how people that are in the stock market and in some funds too, as soon as things look a little scary, the first thing they do is they leave. They take their money and they leave. They try to get their money out and put it in the bank or wherever they think it might be safer, maybe a safe or underneath the mattress. I don't know what they're doing with it.
Mason jar.
Yeah. So it's kind of like a run on the bank. And that's another thing that I think is very important to understand, the strength of your fund manager and how they are allowing people to get their money back out of the fund. Their what's it called? What's the word?
Redeem?
Yeah, redeem. I could.
Or redemptions.
It wouldn't come out of my mouth. So understanding redemptions and how they work, and I mean, like, we've got people that want money out of the fund, but we can't just shovel it all back to them. We'd love to, but we can't because
because funds are not liquid. Number one, no matter what fund you get into, they're not going to be liquid by nature. That said, if everyone tries to pull their money out at the same time, you have assets in place that have to be sold, and typically they're going to be sold at a discount because you got to liquidate. And if you're selling them at a discount, that's bringing down everybody else's yields.
It hurts the whole the everybody in the fund. Right.
So that being said, again, funds are long-term investments, and funds backed by real estate, in my opinion, are the safest out of all of them. It's just very important that you do your due diligence on the operators or the fund managers, right?
Yep.
I agree.
What else?
Yeah.
I'm sorry. What were you going to say, Jonathan?
I was going to say, you do your due diligence on the operators, and also, if any of them ever say, this is the place where you should park all your money, you should run from them.
Yeah.
Because I think Bill and Wendy and even myself, people have asked that. Well, could I just put all my money there? And I would say, yeah, you could, but I wouldn't let you. Like you need to put it in multiple places. I had a conversation with a guy earlier today, and we're talking about the fund, and he's he was just saying, man, 6, 7, 8% isn't enough for me. I have these other funds that I'm in that are yielding 14 to 20%. And I said, that's great. What are those funds? And they're mostly commercial, like purchase, syndication, stuff like that. And I said, well, in the last 2 quarters, what have you made off of it? 0. It's like, wow. 6, 7, 8% is not better than 0. Okay, got it.
That's so true.
So you it's great to make that, but the thing is, you need to not just have all your money tied up in that, because look where we are, and it's like Bill said, it's a cyclical thing. Like it happens periodically throughout the cycle, and you need to have your money in multiple places so when one's not paying, the other is.
Yeah, you need to have a diversified portfolio.
Yeah,
and the risk of each bucket of money is going to be determined by how long it's going to be before you need it to live off of, right? So that's going to be different for everyone.
And it changes.
Depending on their age and depending on their needs and what we call the burn rate.
Right.
Yeah, like for me, like I'm in growth mode. I'm a little younger.
I'll rub it in.
You all might still be in growth mode, but you might be in, a little more conservative
Unfortunately,
mode.
it's my waistline.
Yeah.
But that's right. Being in growth mode, your attitude about your money is completely different. You're in a position where you can be more risky because you got time to
make it back.
To make it up in case something really goes off the rails.
And I know we talk about this all the time, but every investment has a bit of risk attached to it.
Right.
And the key, and what I like about us in particular, and any other lending funds that are dealing in the single family space, is that the single family space, and it could be performing and non-performing notes that are on single family as well. Those are the properties that are the most valued. They're going to be in smaller chunks, but those are the properties that are the most liquid because most people want them. And they're going to be the least risky because you're going to have that money diversified over many notes and many properties versus a syndication where it's going to be, one single asset. That's not much different than being a private lender,
Right.
and you're loaning money on one asset. You
That's
have
right.
a chunk of change in the one asset, so that your chance of that deal going south is higher,
Right.
because you're only dealing with one asset. Now, it doesn't mean you're going to lose money when it goes south. It's just going to be a heck of a lot more hassle.
Well, it takes your energy away from growth,
Right.
From doing, that's the one thing that you're going to spend 90% of your time on rather than 10% of your time on. And it's going to hurt you from being able to do other things. I mean, if I had $500,000 to lend, I'd rather make 5 $100,000 loans than one $500,000 loan, even if I was making more money off of that one $500,000 loan. If my interest rate were higher, if I were charging more points, I'd rather split it up and do the smaller $100,000 loans. Same thing when you're buying notes. I just want to be diversified, and everybody should be. Jonathan, you brought up the guy you were talking to this morning that says he's making 14 to 20% on his funds that he's investing in. And, that's great and wonderful. At my age, 59 years old, I'd love to be in one of those funds, but I just want a small portion of my money in a fund that's going to be earning that kind of interest. I'd rather keep the rest of my money in funds that I feel are a little safer bet for me.
Yeah, I love one of our investors. We were talking about a deal, and I said, "Oh yeah, this is a different setup, completely different thing. I don't know, I think it was like 14 or 15%." And his exact words were, "Ooh, sounds dangerous. Tell me more." But when you hear those numbers, it should be an indication to you that, okay, let me ask some more questions. Let me dig a little deeper, because like you just said, everyone wants to make 14%, but how are you making it? And what's the risks associated with it?
Right. The other kind of funds that, and we're investing in some like this as well, where the interest rate is low. The return is going to be low. We know, we might be getting 4, 5, 6% on the regular returns, but we're going to get a piece of the action. We're going to get a piece of ownership or a piece of equity on top of that. And it may be 5 years before we see that. It may be 10 years before we see that. But as a whole, when you put that together, it's a better return. There are things that go along with that. If it's property that's invested in, you're going to be able to count depreciation and things like that on your taxes that add other benefits to the fact that you're getting, a lower interest rate on something like that.
And you'll be able to pay the recapture when it sells for a profit.
Well, we ignore that part. That's when you stick your head in the sand. Hopefully the rules of the game will change and they'll let you keep more.
No, what you do is you put it into a 1031 exchange.
That's right.
And then you let your kids pay for it after you die.
That's right.
Here's your legacy. Pay some taxes.
That's right. You little rotten kid. That's funny.
What time is it?
It's 1:49. Do you have somewhere to go, Bill?
Yeah, I'm hungry.
This would be a great time. If anybody has any questions, you can type a question into the chat. We'd love to elaborate on anything like that for you. We thrive off of being able to help other people make really, really smart decisions on what they're investing in, right?
Yeah. And we love answering those dirty questions, those hard questions.
That's right.
It's fun. I mean, we get actually we just have a question right here.
Yeah.
Do you factor taxes into your investment strategies?
Well, you should factor taxes into all your investment strategies. If you're going to use any type of a vehicle that doesn't have a tax deduction as part of it, then you want to try to use tax exempt or tax deferred vehicles. In other words, a lending fund, for example, you're going to pay income tax on any kind of lending fund. There's no tax deduction in lending. So it makes more sense to use an IRA
Right.
to invest in that. If you're going to invest in a fund that owns property, use cash for that. That way you can take advantage of the depreciation that can be passed through.
Right. We have another question here too. I love it.
Sushma, how are you? I can't read that.
What would be 5 other funds according to you to diversify? That's a great question.
Well, there's, I can't give you any particular names.
Why?
But you want to look,
Why can't we?
because I don't want to hurt anybody's feelings.
Well,
So
we have
here-
a lot.
Yeah, I know, but I would rather you take those fund sectors. So funds that invest in notes, not
Yeah.
necessarily lending,
That's a good one.
but buying distressed notes
That's a good one.
and working them out.
Yeah.
Mobile homes would be another one.
Yeah.
A fund that has
That's great,
mobile home
Jonathan.
parks in them,
Mm-hmm.
and perhaps a fund that sort of like our friend Glenn that does individual mobile homes that are
Yep.
turnkey rentals.
Right.
You also look at the self-storage
Yeah.
sector. That is very recession resistance.
And then
You
the
got
senior living.
Yep, senior living.
Senior living funds.
And then there's nothing wrong with multifamily either.
Yeah, that's right.
There's the difference is, to me right now, I wouldn't get into a fund that is syndicating Class A multifamily. And what I mean by that is it's the higher, more expensive apartment complexes and things of that nature, the mixed use stuff, the high dollar stuff. Because what happens in a recession, people want to spend less money
Mm-hmm.
because they're either going to hoard cash
Mm-hmm.
or they can't afford it anymore. So they're moving down a rung.
Yeah.
So those value add multifamilies where you're taking a D plus and a B plus and moving it up a little bit.
Mhm.
Those are the ones you want to get into in the multifamily side of things.
And Sushma,
See-
if you'll email us, we will give you, we'll introduce you to people that we know.
Absolutely. Yep. absolutely.
You may already know most of them anyway. But
and then the senior living, by the way, we're all getting older. That's not going to stop.
yeah, that's for sure.
So that's a great sector to be in.
Yeah.
So there,
Another one would be funds in non-performing notes.
Yeah,
which
we already
is a
talked-
good opportunity. Oh, I thought you said
I mentioned
performing
that in the
notes.
front. Distressed
Oh,
note.
okay.
Yeah.
Okay. Gotcha. Yeah.
Well, yeah, they're somewhat performing. But there's nothing wrong with getting them with performing notes either. Now, you're going to get, your return is going to be
Lower.
on the really low end of the scale. But if they're performing, that means they're going to be much safer, right?
That's right. That's right.
But they're still going to be diversified over owner occupant. Typically, if they're performing notes and they're longer term notes, they're going to be people that occupy those homes and have a reason to stay.
Right. Now
Right.
you'll notice that we didn't name oil and gas. We didn't talk about precious metals. We haven't talked about any new solar energy or anything like that. We didn't talk about that. And guess why we haven't brought that up? Because we don't know anything about it. And we would never recommend something that we don't know anything about. We would never invest in something that we haven't done a thorough due diligence homework on. And not only would we want to do the due diligence on the product or whatever it is that they're investing in, you want to do that same due diligence on the fund administrator and operator, the fund operator to begin with, right?
Yeah. No. Your fund is only as good as the operator.
That's exactly right.
And there are some funds that invest in other funds.
Hmm.
So
And that's not bad if you know what funds they're investing
yeah,
in.
but it'll be part of that PPM that you have to read.
Right.
As
Private placement
the
memorandum.
sectors that they're investing in, and they invest in other funds as well. So they're essentially taking that risk and distributing it among other funds. I give you an example. The credit unions, thanks to home mortgages being sold on the secondary market, really don't have a place in there. So they've gone more commercial, but they don't want to do what the savings and loans did by just taking all the risk themselves. So a lot of the credit unions out there now, 3, 4, 5 of them will get together and they'll make a loan on one apartment complex.
Right.
So they're diversifying the risk. So that's the same thing you do with a fund, where a fund to fund investment, they'll take some money here and some money there, and they'll diversify it among other funds. And so that makes you a really nice diversified portfolio. But yeah, shoot us an email and we'll give you some actual names.
For sure.
All right, it's time to wrap this up because Bill's hungry.
He's getting hangry.
Anyway, guys, thank you so much for joining us. Again, our website is carolinahardmoney.com. If you're a borrower interested in borrowing, click on the borrower tab. A lot of borrowing going on there.
Hopefully there is.
Investors looking to get passive returns, click on the investor tab. Don't forget to like, share, and subscribe to our show. And we'll have more burning questions next week.
That's right. Thank you so much. See you later, Jonathan.
Bye.
Thanks.